Stop for a second, because what you're looking at right now is not just a price. Silver at $68 down over 14% this week. Gold near $4,494, marking its worst weekly performance since September 2011. This feels like collapse. It feels like something broke, and that's exactly why it matters. Because moments like this are where perception and reality begin to separate. The chart is telling you one story: weakness, capitulation, people exiting. The headlines are reinforcing it. But underneath that surface, something else is happening. Something quieter, but far more important. This isn't just a decline, it's a transition. Every major cycle has a phase where confidence disappears faster than value does, where price falls not because the underlying thesis is broken, but because participants no longer have the capacity or the conviction to hold. That's where we are now. And the reason this moment matters isn't because silver is at $68. It's because of who is reacting to that number. And why? Because when the crowd starts to exit in unison, the market doesn't end. It changes hands. Now look deeper. Because what's driving this move isn't data. It's behavior under pressure. The comments, the sentiment, the tone across the market all point to the same thing. Because once fear takes over, the market stops being analytical and becomes reactive. Retail participants who entered during the 2025 rally, when silver ran over 135% and gold surged 66%, are now facing their first real drawdown. And without a long-term framework, they don't hold, they exit. You see it in the language. I'm selling before it drops further. That's not strategy, that's survival instinct. And here's the part most people miss. This kind of selling doesn't come from the thesis breaking, it comes from the holder breaking. Because in volatile markets, price doesn't just test levels, it tests conviction. So when silver sits at $68 and people begin to capitulate, understand what you're really watching. This isn't just selling, it's belief being unwound in real time. And once belief leaves the market, something else always steps in to replace it. Now let's move from emotion to mechanism. Because price doesn't fall on feelings alone, it falls on structure breaking under pressure. What you're seeing in silver right now is the result of forced deleveraging across the paper market. Futures positions, ETFs, systematic funds, these aren't exiting because they changed their view on silver. They're exiting because the rules of the system are forcing them to. When silver traded above $100 during the peak, leverage built up across the system. Positions expanded. Risk models adjusted. Capital flowed in. But when momentum reverses, that same structure unwinds in the opposite direction. And it does so mechanically. We saw nearly 2 billion ounces of paper silver traded in a single day, more than twice annual global mine supply. That's not price discovery, that's liquidity being pulled through the system at speed. And when that happens, it doesn't matter what you believe about silver. The system doesn't ask for your thesis, it asks for your margin. So when price drops to $68, it's not telling you silver is worthless. It's telling you that leverage is being flushed out faster than conviction can absorb it, and until that process finishes, price will continue to reflect pressure, not value. And now we step into the layer that actually drives all of this, the macro pressure building behind the scenes. Because this move in silver doesn't exist in isolation. It's happening at the same time the Federal Reserve signals higher for longer, while the Iran conflict pushes oil toward $110 per barrel. And global markets shift into a defensive posture. That combination matters. Because when energy prices rise, inflation expectations rise with them. And when inflation rises, central banks, from the Fed to the ECB and Bank of England, lose the flexibility to ease policy. They don't choose to stay tight, they're forced to. And once that happens, liquidity doesn't disappear overnight, but it starts to tighten at the edges. That's when you see the first cracks. Dollar demand increases, risk assets begin to wobble, and even metals assets traditionally seen as protection start to come under pressure in the paper market. So when silver trades at $68, it's not just reacting to its own supply and demand, it's reacting to a system where policy, energy, and liquidity are all converging at the same point. And when those forces align like this, the move you see in price is just the surface of something much deeper still unfolding. And this is where the market quietly shifts into a different game. Because silver is no longer just competing with itself, it's competing with yield, stability, and certainty. With the US 10-year Treasury hovering near 4.4%, investors are no longer forced into risk. They're being offered a return simply for waiting. And that changes behavior at scale. Because in a world where central banks, from the Federal Reserve to the ECB, are holding policy tight, capital begins to ask a different question. Not what has the most upside, but what pays me while uncertainty unfolds. Silver doesn't answer that question. It doesn't yield. It doesn't compound. It requires storage, patience, and conviction. So in the short term, money rotates. Not because silver has lost its long-term value, but because the system is temporarily rewarding liquidity and income over protection. That's why you can have silver at $68 even as inflation risks remain elevated. Even as physical demand continues, because markets are not just pricing value, they are pricing opportunity cost. And until that cost changes, until yield falls or risk rises further. Every rally in silver isn't just a move higher, it's a move that has to fight against the gravity of the system itself. And this is where the structure of the market becomes visible. Because beneath the price drop, what's really happening is positioning being cleared out, layer by layer. Look at the signals. Leveraged funds exiting, ETFs unwinding, mining equities from Teck Resources to First Majestic and Core Mining dropping close to 8 to 10%. Not because the metal disappeared, but because the positions built during the rally are now being forced to close. Open interest is falling, liquidity is tightening, and the system is doing what it always does under stress. It starts to shed excess risk. This isn't accumulation, this is decompression of leverage. Because when silver ran from the mid-30s to over 120 zekas, that move didn't happen in isolation. It attracted momentum capital, systematic funds, retail chasing performance. And now that momentum has reversed, the same capital exits, not thoughtfully, but mechanically. That's why the move feels violent. Because it is. So when silver trades at $68, understand what you're actually seeing. It's not the market deciding what silver is worth. It's the market deciding how much risk it can no longer carry. And until that excess risk is fully removed, the system isn't building a bottom yet. It's still clearing the space for one. And this is where the contradiction becomes impossible to ignore. Because while price is falling, the physical market is telling a completely different story. The COMEX vault now sits near 332 million ounces, down almost 2 million ounces in a single session, continuing a multi-week drain from over 349 million ounces just weeks ago. That metal didn't disappear. It moved. It left the exchange system and went into stronger hands. At the same time, delivery demand remains real. Over 41 million ounces stood for delivery in March, and the registered pool is sitting near 79 million ounces. That ratio matters, because it tells you the system is tightening at the level that actually fulfills obligations. So you have two signals moving in opposite directions. The paper market says silver is weak, price down, sentiment collapsing. Traders exiting. The physical market says silver is being absorbed, vaults draining, delivery continuing, supply tightening. Those two realities cannot diverge forever. So when silver trades at $68, understand this, it's not equilibrium, it's dislocation between perception and reality. Silver at $68, down sharply from the highs above $120. Gold near $4,494. Central banks from the Federal Reserve to the ECB and BOE holding policy tight. The US dollar firm. And inflation pressures still elevated as the Iran-driven energy shock moves through the system. None of these forces exist in isolation. They are compressing into the same moment. So the real question isn't whether this is the bottom. The real question is, who is holding the metal when the system stabilizes? Because right now, momentum money is exiting. Retail is capitulating. Leverage is being cleared, but at the same time, the COMEX vault continues to drain, physical buyers continue to take delivery, and structural demand hasn't moved. That's the shift. Ownership is changing. And when the forced selling phase ends, when the last wave of deleveraging runs its course, the price that remains won't reflect fear anymore. It will reflect who accumulated during the pressure. And by then, the move won't begin slowly. It will begin from a level most people already gave up on.